Okay, guys, so we're going to be looking at financial ratios that's going to be tested in the HSC business studies. So we have four main businesses' financial objectives. That is liquidity, liquidity, efficiency, liquidity, efficiency, profitability, liquidity, efficiency, profitability, and gearing. Gearing is also known as solvency. Okay, so let's look into each one of these. First, let's look into this thing called liquidity. First, let's define liquidity. What is liquidity? Well, defining liquidity, liquidity is the ability of the business to pay its short-term debts or to meet its financial obligations as they fall due. So, that is liquidity. Or in other words, people can be like how quickly a business can, transform or convert its assets, so things that they own, into cash. How fast they can do that? Why? To meet the financial obligations as they fall due. That is all liquidity is about. It's measuring whether the business is able to pay its short-term debts. Okay. Now, how can we measure this liquidity? Well, we have this simple ratio. It's called the working capital ratio. Okay. Working capital ratio. And the formula for this is quite simply total assets over total liabilities. And it kind of ties in when you think that you're measuring liquidity. What do you want to measure liquidity? When you're measuring liquidity, you're meeting the business's ability to pay its short term debts. How are they going to pay it? By converting their assets into cash. It doesn't really mean assets as long-term assets because assets include two things, right? They're one, current assets, and two, non-current assets. When we think of assets, we typically think of non-current assets like, land, selling the land to this. But it also includes current assets like the products that they earn. Even that's an asset. The products that they've produced is an asset. For them, they only get cash when what? What do? When they sell. When they sell the product, they get cash. And then with that cash, they're able to meet their liabilities, so the raw materials, cost for that, rent, blah blah, and then they're able to enjoy the profits. And we look at how profits tie in with the next ratios. But right now, let's just look at this one. What is it? Working capital ratio. Okay, total assets over total liabilities. Quite simple, quite easy to understand. Now, what does this measure? This, as I've said earlier, it measures the business's short-term financial stability. So you want to be able to memorize that. Short-term financial stability. So the liquidity ratio measures the business's short-term financial stability. Okay, all good. Now, how do we actually calculate this ratio? Now, suppose you know, you calculate this ratio from the balance sheet because the balance sheet has all this. It tells you, okay, the business's current and non-current assets and the business's liabilities, so current and non-current liabilities. So you take those figures from the balance sheet, you add them up, and you put them into the formula. And for example, say that the business has $300,000 worth of assets and they have about $200,000 of liabilities. Well, chuck that into your calculator, and that's going to give you, well, basically 3 on 2. 3 divided by 2 is 1.5. Okay. Now, how do you write it as a ratio? Ratios are just fractions. So you just write this number as it is. 1.1 is to these two symbols 1. That is your ratio. Okay. That's your ratio. Now, okay, all good. We got the ratio. But now, what is this ratio telling us about the business? A ratio of 1.5 is to 1. What is this telling us? Well, it's telling us that the firm has $1.5 of current assets for every dollar of liabilities. $1.5 of assets for every dollar of liabilities. For every $1 of liabilities. So that's what it's telling us. It's telling us that for 1.5, it has $1.5 for every $1 of liabilities. Well, this, right, is a ratio under 2. Typically, the board of studies, they're splitting it into two things. If it's a ratio of 2 is to 1, but if it's greater or greater than 2 is to 1. If it's less than 2 is to 1, which our thing falls under, they're telling that the business is, it indicates there are insufficient assets to pay its current liabilities because it's acceptable, but it's not really the best because a business may face liquidity issues and short-term, you know, inability to pay short-term obligations. So this, what do you say? First, your first sentence is going to be, well, you want to compare, the business wants to compare this ratio with its competitors. Business wants to compare this ratio against its competitors, its competitors, mar, industry average, and past performance. Okay, because these ratios, right, they vary from what do you call industry to industry. For some businesses, it's completely fine to have high high liabilities and insufficient cash. For example, companies like supermarkets and constructions, right? They have very low, very, very low, what do you call, assets at any given point in time. Because take Woolies, right? Woolies is current ratio will look something like 1.8 is to 1. So they have $0.8, so 80 cents for every dollar of liabilities. So doesn't mean that insufficient to pay its liabilities? Well, not exactly, because when you take supermarkets case and retail's case, they have to sell their product in order to get the money to pay its liabilities. So once they sell it, they get money to pay the liabilities. But then if you look at tech, that's not the case. Hence, they have very, very high. Okay? So ratio of 2 is to 1, as I said earlier, it indicates financial instability. Financial instability. The business may not be able to meet its short term obligations. So it's as simple as that, and you leave it there. And what if it's about 2 is to 1? Well, if it's about 2 is to 1, it indicates that the business is liquid, the business is in a sound financial position, and it's able to meet its short term financial obligations, as I told you. So it's all good. But there's also a risk if the business's ratio is too high. Say if it's 5 is to 1, that is also not good. Investors are not going to like this because it's showing that the business has too much cash, too much money sitting around in the bank doing nothing. They have too much assets that are not generating revenue. So it shows inefficient use of resources to generate revenue because look, you have $500,000 for every $1,000 of liabilities. Well, sure, you can take that as profit and go away, but you're not really making the business better at this point. You want to be continually reinvesting into the business such that you want a ratio closer to 2 is to 1, basically. Maybe 3 is to 1, but too high indicates insufficient use of resources to generate further revenue, insufficiently using assets to generate further revenue. So it indicates bad. Okay? So that is all about liquidity. Now, it also comes in how to improve liquidity. So that's a common thing. How can you improve liquidity? We looked at liquidity, what is liquidity and the ratios. How can we improve a business's liquidity based on the financial data? Well, one, at any given time to improve liquidity. What's liquidity again? Just try to bring it to your brain again. It's a business's ability to meet its short term obligations. So it's one, they can either sell their non current assets and lease them. Sell non current assets and lease them. Okay? Why would they want to do this? Now think about it. When you sell your non current assets, the business gets cash. If they sell like their land, they're getting a lump sum payment of cash, which they can use to meet their short-term obligations, they can use to expand their business, blah blah, and they can just lease it back. And when they lease it, you also get tax benefits, so tax deductions. So it's a win-win. It might be expensive over the long run if the business continues to, you know, walk into this avenue. Two, to improve liquidity, you can improve your credit policy, improve accounts receivable policy, improve your credits policy, get your accounts receivable back as soon as possible because you don't want to be waiting. You don't want to sell your product and then wait for cash. Okay. And then you can also reduce your inventory levels to improve liquidity. Use it just in time because you don't want stocks to get outdated. You don't want them to go get redundant. And then you can also reduce your current liabilities. You can try reducing your levels of debt. You can try reducing your level of just expenses overall. And discount early payments. Discount early payments. Worst case scenario, you can go factoring. Okay. That is all about liquidity. Thank you for watching.